All right, welcome to Talk Tickers. So Zion's Bancorp's third quarter, it was a real roller coaster. You had this massive credit loss that sent shockwaves through the market. But then something weird happened. The stock rallied. So what in the world is going on here? Today, we're going to dig in and figure it out.
Okay, so let's get right into it. Despite this huge, pre-announced credit loss that absolutely hammered the stock the week before, Zion's pops almost 3% in after-hours trading right after the full earnings report drops. I mean, come on, that tells you the market saw something else, something it really liked.
So that's the big question, right? How on earth does a stock rally after a $50 million credit shock? Well, it turns out the answer wasn't in those scary headlines at all. It was buried deep in the bank's core performance.
All right, let's kick things off with the headline numbers, because the way the market reacted tells you everything. Investors were basically willing to say, okay, we'll forgive that big credit mess, because the core results were just that strong. They looked right past the drama and focused on the fundamentals.
And here's the proof in the pudding. Zion's delivered GAAP earnings per share of $1.48. That's a beat, about 2 cents over what analysts were expecting. But look, the real story here was revenue. They pulled in about $872 million. That's not just a beat. That's a nearly $30 million beat. We're talking up over 8% from last year. Now that gets Wall Street's attention.
But hey, those headline beats, they're really just the start of the story. The real good news, the stuff that got the bulls excited, is what's happening under the hood in the core engine of the bank. This is where it gets really interesting.
First up, net interest margin, NIM. It expanded by 25 basis points compared to last year, hitting 3.28%. Now, for a bank, NIM is everything. It's basically the profit margin they make on their loans. And in this kind of environment, where every little bit counts, a 25 basis point expansion, that is a huge tailwind for their earnings.
Next, let's talk about the bank's pure, raw earning power. We're looking at something called pre-provision net revenue, or PPNR. And get this, it grew a massive 14% year over year. Think about that. This is the bank's profit before they set aside money for any loan losses. Seeing double-digit growth here, that's a massive green flag for any investor. And it doesn't stop there. Core deposit growth was solid too. If you strip out the brokered deposits, their balances grew at a 7% annualized rate just in the quarter. Why does that matter? Well, it signals that their main franchise is healthy and stable. It gives them a cheap and, more importantly, a reliable source of cash to fund future loans. Okay, so things are looking pretty good, right? But it wasn't all sunshine and roses. We have to talk about the elephant in the room, that massive credit loss that totally spooked the market. This right here is the core of the bear case against Zion's. So how did management handle it? Well, they were very, very clear in their messaging. The CEO, Harris Simmons, came right out and said, quote, "We view this as an isolated situation. The whole game plan in the earnings call was to build a wall around this problem, to convince everyone this was a one-off and not a sign of some bigger rot in the system."
And you know what? They didn't just talk, they took action, and they did it fast. Step 1, they charged off the full $50 million, just took the hit. Step 2, they set aside 100% reserve for the remaining $10 million, no messing around. And Step 3, they went on the attack, filing a lawsuit to try and claw all $60 million back. I mean, this is basically a textbook crisis management playbook.
And this is the part that really got investors to listen. Management pointed out that if you just pull this one single event out of the numbers, the rest of the loan book looks fantastic. Net charge-offs were, in their words, a very benign 4 basis points. That's practically nothing, and it really helped sell that story that the underlying business is rock solid.
Okay, so we've got the bull case and we've got the bear case. So what's next? Where does Zion's go from here? Let's take a look at what management is saying about the future and what we should all be watching for. So, looking forward, management sounds pretty confident. They're guiding for moderately increasing net interest income, and this is the really crucial part, a continued path to positive operating leverage. Now, that's just a fancy finance term for saying they expect their revenues to grow faster than their costs. And let me tell you, for investors, that is music to their ears. It's the recipe for higher profits. So, over the next few months, here's what you need to keep your eyes on. First, any updates on that lawsuit to recover the $60 million. That's a big one. Second, you got to watch the Q4 balance sheet trends, deposits, loans, and especially that NIM. Third, what's the rest of the regional banking sector doing? And finally, we'll get their formal, detailed guidance for 2026 at the end of the year. That'll be huge.
All right, time to put it all together. What's our take on all this as we head into the next quarter? What's the call?
You know, the whole debate really boils down to this one simple question. The bulls are saying, look, the core engine is humming, NIM is expanding, deposits are growing. This credit thing was a weird fluke. But the bears are whispering, hold on, what if that shock wasn't a fluke? What if it's a crack in the foundation, a sign of a real weakness in how they manage risk?
So where do we come down on this? For now, we're slapping a market perform rating on Zions. Look, the core business looks great, and management's response was impressive. But the burden of proof is totally on them now. They have got to prove to the market that this was a one-time screw-up, not a sign of bigger problems lurking under the surface. Until they do that, we think the stock is probably just going to trade in line with its peers.
Okay, but let's say you want a more interesting trade idea. If you're a true believer in Zion's management, if you think their core strengths are really going to shine, you could think about a paired trade. Go long on Zion stock, but at the same time short the regional bank ETF, KRE. Basically, you're betting that even if the whole sector hits a rough patch, Zion's is strong enough to outperform its rivals.
And of course, remember, this is not financial advice.